Now that we have found out how to calculate amortization on bonds premium, in case of the straight line method, which basically means that we have to divide into equal parts and use exactly the same amount to amortize it to down to zero. Now, there's a second method which is called effective interest method. This is the most used one, and this one is the one that is required by the IFRSs, and therefore this is the one that probably you should pay attention most to. Now, the logic is exactly the same. However, the calculation is a bit more complicated than the one that we do with the straight line. The straight line basically divides into equal parts. This one is going to use the known interest, stated interest rate, and then the market interest rate, and then calculate their differences. Now, let me just add a bit more lines to it. So let's imagine that this one is not paid annually but semi-annually. Yeah, so this interest payment is paid semi-annually, June 2021, and then we will add another one. So make it semi-annual, basically. No, yep, that was the right one. Yeah, that was the right one. So 31st again, June 22, and then yeah, so I'll just basically create this additional payment dates, so it will be more of a practice for you guys as well. Yeah, so and two more, June 23, I'm sorry, 24, and finally June 25. Yeah, so this means this is a semi-annual payment for each, so I hope it won't confuse you, but we need to also see how it's going to go semi-annual as well. Now that interest payment stated is 9%, it's going to be divided into or multiplied by 6 divided by 12, 6, not 3. 6 months, because it's a half a year. The same goes with the market interest rate, 6 divided by 12, yeah, half a year, and that's how we're going to find the information. So how is it done? Yeah, again, just to repeat it, in the straight line method we have exactly the same amortization in the bonds of premium, which is 812. I could actually add here as well, but it's not important. We already saw it how it's done. And so let's look how it is done using this effective interest method. Again, I repeat, IFRS requires it, so this is the one that you should probably focus most on. I will be testing you on both. However, the logic is exactly the same. The calculations are simply different. So what we know in the beginning, the issuance year, so I'll just highlight it. So on January 1, amortization, we don't have any interest payments yet. We don't have any interest expenses because this is just the beginning. The same goes for amortization on premium. What we know by far is the credit balance on in our premium on bonds payable account, and that is 4,100 because that's the difference between the stated price. The credit in bonds payable is 100,000, and the book value of bonds is 104,000. Sorry, 104,100 in the book value of bonds. We already know that, and I can actually highlight it just to show out that this is basically the starting point. Now, when it comes to interest payment that we need to calculate, and interest payment is going to be based on our stated interest value, and that is simple. Yeah, so we have our 100,000 stated face value of our bond multiplied by 9% divided by 2, because we are finding a half a year, so semi-annual, so 4.5%. So it should give us 4,500. And since that value is not going to change, we're continuously going to multiply 100. Yeah, so exactly the same thing. So 100,000 multiplied by 4.5% until the very end. So the interest payment is going to be all the time semi-annually, so meaning this together is annual, but semi-annually 4,500. Now, interest expense, on the other hand, is going to be calculated based on our market value multiplied by the book value. So the book value of the bond is 104. In this case, yeah, in the beginning of the first year, this is the 104,100. So 104,100 multiplied by so 8%. Yeah, so let me just use the just a second, yeah, 8% multiplied by this, it gives us 4%. That is supposed to be semi-annually. Yeah, so that's what I'm gonna do, multiplied by 4%, and that's gonna give us 4,164. Now the next thing to do is to find out what is the amortization of bond premium, and we will be journalizing, and the amount in this case will be bonds of premium. So this minus this, yeah, gives us 336. That's going to be amortization of bonds premium, so in the middle of the first year. So the balance in the bonds premium is going to be the difference between the original entry and then the second entry, which is 3,764. Now, again, I could have just copy pasted all of these because the credit balance in the bonds payable is never going to change until the end. Yeah, so, excuse me for that noise. And the book value, however, is going to change. The book value now is going to be 104,000. Just a second. Minus the credit balance. Just a second. I could have done it the other way, but okay, minus this one. Yeah, so it's going to give us 103,764. So I can apply exactly the same formula because this is an Excel file. I can apply exactly the same thing. Just to show you a couple of more so that you could get used to it, I will do it at longhand again. So interest expense on the at the end of the first year, so the second half, yeah, of the year, is going to be again multiplying the beginning. At that point, beginning is 103 multiplied by 4%, is going to give us now 4,150. So I'm not rounding it up. I have decimals here, but I could have. I will round it up later on. And then we have. So that's going to be interest expense, and the difference between the interest expense, meaning this, and the interest payment is going to be our amortization. Again, I can just drag the formula, and if I click on it, I will see that the details, right? So the interest payment minus the interest expense will be equal to our amortization of bonds premium at that point. And my credit balance will be again, so this 3,764 minus 340, so this minus 349 is going to be 3,414 or 15, yeah, if we round it up. And the same way, now I can just simply drag this formula downwards all the time, yeah, until the end. Just a second, and this one, so it's gonna all be fixed. Sorry, I don't need the end of it. Yeah, so I need to probably round it up a little bit, and then it will be fixed much better. So if I will just remove the decimals, I don't know if you can see it once I do it. When I'm doing it, I don't think so. However, yeah, I'll just remove all the decimals, and it will just a second, remove all the decimals, and then remove the decimals here as well. It should give me a clearer, better look. Here it is. Now that we've rounded it up, we can see that there is a 66 rounding error or difference, and this rounding error can be just inputted or reduced from interest expense, and yeah. And that's basically it. We're going to reduce the interest expense because we're using only our Excel to make this calculation. This is going to give us, but if we use more accurate financial calculators, this error is not going to occur. But since this is what's happening, we can just basically add it to or remove it from the interest expense. Our amortization of bond premium is going to go a bit higher. Yeah, so it's going to be increased by 66. However, our premium bonds on payable balance will go down to 0, and all the numbers will be cleared. So this is how it's done when using the effective interest method. So what we have here is basically the information that we need to make our journal entries. We know the amortization of bond premium, and all we need to do is to make exactly the same type of entries. Yeah, so if I go back, let me just yeah, Yeah, so if we go back and see our entries in here, so the issuance day is going to be exactly the same entries like this. However, if we use, yeah, so let me just bring it down here. If we use just a second, this method, effective interest method, then our interest expense, for example, this is semi-annual. Don't forget, the first one we did was annual, and now we're doing semi-annual. So we're gonna have cash 4,500, which is on so June 31. So this is semi-annual. Yeah, so I can actually write it. Oh, excuse me, 4,500. So this will be on June 31, and this will be on December 31. Yeah, semi-annual. These entries will be made, and then the premium on bonds payable, we have already calculated it. It's 336, and then 349 for December, yeah, entries. So I'm just doing it just to show you that this is semi-annual, and if you would just look at it at the end of the first year, you would have two entries for first and second half of the year. And the interest expense, however, is going to be the difference between this 4,500 and these 336. If we want to reconfirm our calculations, we can just do this, right? So it's going to give us 4,164, which is equal to my table down here. And the same way, it's going to be, yeah, 4,500 minus this 349, which is 4,151. So this is basically how it's done. The entries are exactly the same way, are done exactly the same way. However, the calculation and the amortization table is going to look slightly different. Again, the only reason why I've added this additional years, the additional lines of semi-annual, I just wanted you to know that it's also possible. So in our second example, this is, yeah, interest is paid annually, and that's why in this case we have a bit more of the longer table. However, the calculation is exactly the same way. Yeah, so this is, if you combine it, it's 9,000 in each case anyways. So I hope this was useful and helpful, and we can move on to the discount.